What's up, traders and investors? Welcome to TradersArmy.com's Options Foundations web series. We're going to move on to exercise and assignment, but before we do, make sure you guys understand that you can reach out to us at any time, support@TradersArmy.com for any questions you may have about this or any other web series we have at TradersArmy.com. So exercise and assignment. Remember, guys, we have several positions that we could take between buying calls and puts and selling calls and puts. Again, when you buy an option, you have the right to exercise it. When you sell an option, you have to carry an obligation that in the event the holder of that option exercises their rights, as a seller, you would have to fulfill based on the terms of the contract, whether or not buy their equity from them or sell them your equity. The buyer always pays the premium, and in every case, the seller receives that premium. So with the four possible actions, buy to open, sell to open, buy to close, sell to close, we have two sides of the trade that we could take, calls and puts. Okay, and I always start out with, remember, a buyer of a call option, also known as long the call, has the right to buy the underlying at a set price. The buyer paid the premium to the seller, who now carries the obligation to deliver that underlying stock at a specific price on or before a specific date. Each have their outlooks. One believes the stock will go up, the other believes the stock will stay the same or go down. The put option is a whole nother animal in a sense that when the buyer of the put option pays the premium to the seller, they now have the right to sell the stock at a set price on or before a set date. Their outlook is bearish, meaning they believe the market will go down. The seller of that put option receives premium and carries the obligation that if the buyer exercises their rights, they're under obligation to purchase that underlying stock from them at that set price as long as they exercise their rights before the specific contract expiration date. Their outlook is that the market will stay the same or go higher, inversely to the put option buyer who believes the market will actually go down. Now, the exercise and assignment process is something that takes place with your regular old run-of-the-mill American style options. It can happen anytime prior to the expiration date. If you remember from the very first series on options foundations, what is an option anyway? A European style option can only be assigned or exercised by the buyer at the expiration date. Okay, so the exercise process is really something that the buyer can actually exercise. The buyer of an option can, if they choose to, exercise their rights anytime on or before the specific expiration date. If the buyer exercises their rights, then a seller of that option can be assigned, otherwise known as obligated to fulfill the terms of the contract, but only if the buyer exercises their rights. As a buyer, do you have any obligations? No, you only have rights. As a seller, do you have obligations? Yes, but only if the buyer exercises their rights do you have to fulfill the terms of the contract under obligation. As a seller of the option, can you force someone to exercise their rights? No, you cannot. It's a waiting game to see if the buyer of that option is going to exercise their rights. Now, why would somebody want to exercise their rights? Remember, we just got done talking about intrinsic value versus extrinsic value. Intrinsic value is the real amount by which your option is in the money. It's your real equity. Do you have bragging rights or not? And here's the thought. If you do not have bragging rights within your option contract, would you ever really want to exercise your rights? No, you would not, because it would mean that from a call option standpoint, for that matter, you wouldn't have any bragging rights. You would have zero intrinsic value, zero equity, and zero reason to exercise your rights. Because think about this. If this is your stock trading at 155 currently, and you own the 160 call option, you have the right to buy that stock for the price of $160 a share. You would never want to exercise your rights and buy the stock at 160 when you could just go out on the open market and buy it for 155. It just wouldn't make sense. You'd be throwing away $5. Now, if you owned the 160 put options, where you could sell your stock for 160, you might find it valuable to go ahead and exercise your rights, sell the stock for 160 when the stock is currently trading for 155. So if the option is in the money, it might make sense to exercise your rights. If the stock is out of the money, it would never make sense for anyone to exercise their rights. And just remember, you can only exercise your rights at expiration if you're trading a European style option. You can exercise your rights anytime before expiration if you're trading an American style option. Now, keep in mind that whether it's American style or European style, that can be defined by a couple things. All stock options, all ETF options, those are your exchange traded funds options. Those are all American style. You can exercise your rights and be assigned anytime prior to expiration. Index options, those are your cash settled options. Those are typically going to be your European style options where they can only be exercised assigned at expiration. And if you want to know for sure whether or not your contract is American or European, as I mentioned before, go to the cboe.com/products page at the Chicago Board of Options Exchange, and they'll give you all the components and contract characteristics of all stock, index, and futures options. Now, how does this work? So if you're the holder of an option and you want to exercise your rights for whatever reason, it's a physical phone call to your broker. Okay, so if you're, there's no button in the trading platform or your investment platform that says I want to exercise my rights. It's a phone call, and it's a simple phone call that says, hey, I would like to exercise the rights on this particular option that you can see I have in my account, and they will handle the rest. When I mean they will handle the rest, they will that day take your exercise request, and after the market closes that afternoon, it won't happen right away. It's going to happen later in the afternoon after the stock market has closed, and they're going to look into the short pool, what's known as short pool. So anybody who is short that option today, right now, still after the market is closed, is going to be selected at random to fulfill the terms of the contract that you are now exercising. Your long or short position is not tied to the person that you traded with at the beginning of the trade when you open that trade. There is a long pool and a short pool, and all of that together, all of your buyers and all of your sellers, they actually create all of the open interest. So there is long open interest and there is short open interest. And if you exercise your rights, or if someone exercises their rights, someone from the short interest is going to be assigned. Now, what that means is the very next morning, after they've been assigned on that contract and been notified, here's how you could be notified. You could be typically notified by email or some sort of alert in your trade platform. I don't know if anybody is really making any phone calls anymore to you specifically. It's usually email or some sort of alert within the trading platform, but they can notify you however they see fit, however they choose, whatever their assignment notification process is. So just know that if you're on the long side and you exercise your rights, you're going to see that equity position take place in your account next business day, not immediately. If you're assigned because you were part of the short pool, if you're assigned before expiration, you're not going to get the market, you're not going to get the stock position either taken from you or given to you, sold to you that business day. It's always going to happen the next business morning. It's an overnight process. Now, what if your option is held through expiration and you're still holding it? Okay, if you're still holding this option all the way through expiration, and let's say you're the buyer, okay, you're the holder of this contract. Well, if that option is out of the money, it's not worth anything, it expires worthless. If you were the seller of that option, you get to keep all the premium because it has expired worthless. If that option, however, is in the money by even 1 penny, in the money at expiration, it will automatically have to be exercised and assigned to settle out all the long and short open interest. Remember, somebody has the right and they have bragging rights. Well, if you don't exercise those rights, that's going to happen automatically, and anybody who is short and in the money option at expiration will automatically be assigned and have to fulfill the terms of the contract. So big disclaimer here, if you do not want to exercise or be assigned on those rights and obligations, you should not be holding your options positions through their expiration dates. And as we get later into this web series, where we start getting into actual strategies, the buying and selling of options and spread trading and so forth, we're going to have very specific entry and exit criteria regarding dates, making sure that you're out before expiration so that you don't run into certain issues, this being one of those issues. So just a little disclaimer there, if you hold your expiration, your options through expiration, you will be automatically exercised or assigned if that option is even 1 penny in the money or more. Now you take a look at this. Again, we've already seen this. Again, anything that has intrinsic value at expiration will actually be assigned. But the further away you are from expiration, the less likely you are to be assigned if you are short the options. So let's go with a couple of examples. Let's say you're long, meaning you own the $150 call option, which means you have the right to buy the stock at 150. And you want to exercise it. You called your broker, now what? Well, you do have the right to exercise, but remember, you'll need to have the money to purchase the stock, or half of it if you are using margin. So if this is a $150 strike price, each option contract controls 100 shares of the stock. You're going to own $15,000 worth of stock next business day. So you need to have the money, either $15,000 or if you're using margin. Typically, most margin brokers will give you 2-to-1 margin overnight. Some will even give you 4-to-1 margin. So you'd only have to have really a quarter of the money if you're holding it intraday. But remember, you do have to have the money. So once you buy the stock, you now own the stock and carry full risk of ownership of that stock. So if the stock goes up, great, you own the stock at 150. If the stock stays where it's at, well, your money is sitting there stagnant. If the market goes down, even worse, if it gaps down by the time you can sell it from one day to the next, you carry all the risk of owning that stock at 150 all the way to zero. So just be mindful of that. So another let's say example, okay? Actually, that's the same let's say example. I believe I went back a page. Gotcha. Here we are. So this example is, let's say you are short the $150 call option, which means you have an obligation to deliver or sell stock at $150 a share, and you carry the potential of being assigned. Now what? Well, a couple things. Number one, you cannot force assignment, but it will be automatic at expiration if the option is in the money. That's what ITM stands for, in the money. You'll need to have the stock to sell it, otherwise you'll end up being short the stock. Again, you're obligated to sell the stock, so if you're currently in a stock position and you sell a call against it, that's a strategy known as a covered call. That's perfectly allowed in retirement accounts. It's a very safe position to use with your already long stock position. To sell an option against it only lowers your risk, it lowers your cost basis. It does obligate you to sell that stock, in this case at $150 a share, so you better be okay with that stock being called away from you at 150, or don't sell these options. Okay, if you don't own the stock, then essentially if you're assigned, you're going to be assigned to sell stock you don't owe. So in a margin account, you're going to actually end up shorting that stock, which is just fine within a margin account. But remember, you'll carry all the risk of being short the stock. And the risk is that the market keeps going higher and you're short at 150. If the market goes lower, great, you're short the stock. That's a good thing. But again, you can't force assignment. It's only if someone exercises their rights before expiration. If you are assigned at any point, either before expiration or at expiration, you won't sell the stock immediately. It'll happen next business morning. Okay. Now, also keep in mind that the closer you are to expiration, the closer you are to that option expiring, and if the option is in the money, or if that stock has a dividend announcement or an ex-dividend date is coming up, meaning the stock owners themselves, the people who own the stock, are going to get the dividend. Well, the call option owners don't get the dividend, but if they want the dividend, they could exercise their rights, and some do exercise their rights before ex-dividend date. That way they actually get the dividend themselves. So if the dividend announcement is coming up especially if the option is already in the money. Then your likelihood of being assigned on your short position goes way up. If you're not really close to expiration, it's out of the money. There's no dividend announced or XX dividend coming up, then you're highly unlikely going to be assigned um, until some of those scenarios start to become true, like if you're in the money, if there's a dividend, and if you're close to expiration. Now let's say you are long the put options, right? You're long the puts. So you've purchased a put, which means you believe the stock is going to go down from here and you want to exercise it. You called your broker. Now what? Okay. Now you have the right, but so you exercise your rights. You'll need to have the stock to sell the stock, because that's what you're exercising, is your right to sell the stock. So you'll either need to have the stock and you'll sell that stock outright next business day, or you're going to actually become short the stock because you exercised your rights to sell stock you don't own. And in a margin account, you're going to go short the stock, which means you carry all the risk of going short that stock. But you won't sell the stock immediately. That transaction will be completed next business day. If you had the stock and you exercised your put option, your position in the stock is flat. You no longer own the stock because you exercised your rights to sell it, and now you're out of the stock position. If you didn't have the stock, you'll now be short the stock and carry the unlimited risk characteristics of being short that stock at $150 per share, because that is the strike price that you selected when you opened the position. Now let's talk about the other side of the position, the short put. Okay, you're short the 150 strike put, and you have an obligation to buy that stock, and you carry the potential of being assigned. Now what? Well, first of all, you can't force the assignment. It will be automatic at expiration if it's in the money. In the money is, in this case, if the stock is below 150, someone else has the right to sell you their stock for 150. So if they could sell their stock to you for more, meaning 150, than they could on the open market for less, then rest assured they are going to assign you. You will own that stock at 150, which may be something you want to do. You may actually want to own that stock at 150, and that is a strategy that we're going to cover, which is selling puts as a way to enter into stock positions where you're obligated to buy at a certain price, but it's a price that you were willing to buy it at anyway. This type of strategy that we're going to talk about later allows you to get paid a premium while you wait to see if the stock comes down below, in this case, 150 bucks, so that you get to buy the stock at a price you want, plus you get to keep the premium. But keep in mind, you cannot force someone to exercise their rights, which means you can't force assignment. If you're assigned, again, you'll need to have the money to purchase the stock, or half of it if you're using margin, so keep that in mind. If this is a non-margin account, by the way, say you sold a put option and this is in your IRA, you're absolutely allowed to do that as long as your broker gives you authority to do it. But the broker is going to need to know that you have the money to fulfill the terms of the contract. So how much money are they going to require? Well, since this is a 100 share position at $150 per share, the broker will actually hold $15,000 of your money aside, call it as collateral in a little holding tank as if, and they'll hold it there as long as you carry this obligation. If you close out the obligation, you won't have to hold that money anymore. But as long as you carry that obligation, the broker needs to know that you have the money to pay for the stock if you're assigned the stock and if you have to purchase it. So they're just going to simply hold the $15,000 on the sidelines, and you can't use it for anything except for purchasing this particular stock. Again, if you're assigned, you won't receive the stock immediately. You will receive it the next business day. And again, the closer you are to expiration, if the option is in the money, your likelihood of being assigned goes up. If you're not really close to expiration and the option is still out of the money, it's not in the money at all, it is highly unlikely, I would say almost impossible, that you will be assigned on any option that is out of the money, especially put options. Okay, so that's the process by which we exercise our rights or become assigned on an option. And like I said, for all of the European style options, all of that is going to happen at expiration. Any of your American style options, that process could take place anytime between opening your option position all the way out until options expiration of that particular contract. Now, as we get to the different strategies down the road here in our web series for options foundations, we'll start to again build very specific guidelines around when would we want to exercise our rights, when would we not. When would we want to be assigned on our short options positions? When would we not? So I'm just going over simple concepts here to help describe what exercise and assignment is. We finished up liquidity, and we'll move on to the next web series as we get deeper and deeper into options investing and trading and the foundations of terminology. Take care. Thanks for joining us. We'll see you in the next web series.